Hey y'all, it's Michael. Welcome back to the channel. And before we do anything today, I want you to hit the like and subscribe button. Yes, I will wait. As with all of the videos I'm creating, my goal here is to save you thousands of dollars through smart investment strategies and to additionally make you that much more money. I'm not exaggerating. I want you to think today, because we're talking about mortgages, interest, and principal payments. So for all my homeowners out there, 90% of people don't actually know this information, so pay attention. If you have a $400,000 mortgage at a 6% interest rate, just adding $50 a month to your principal payment can help save you over $30,000. That's right. $50 a month could save you $30,000 in interest paid. If you were to add $200 a month, you can save almost $90,000 and cut 7 years off of that 30-year mortgage. 7 years, that's crazy. That's like insane for the price of a Costco run. And the wild part, most homeowners have no idea their mortgage even works this way. So today, I'm gonna show you exactly how it works with real numbers and how a very small extra payment hits your loan like a wrecking ball. I got it like a wrecking ball! In the best way possible. And later on, I want to show you the additional advantages, because for most of you buyers out there, you didn't put 20% down on the home, and I'm going to show you how hitting that 78% equity position can actually lower your monthly mortgage payment in real time. It's called private mortgage insurance. It's a bullshit payment that they tack onto your loan if you don't put 20% down, and we're going to show you today how to get rid of it. Okay, so that's like giving yourself a little extra rate, like a raise every month by using this smart strategy. All right, let's get into it. For a $100,000 loan on a standard 30-year fixed mortgage at 6% comes out to a monthly payment of about $23.98, so about $2,400, right? And during the first few years, almost none of that payment, of that $2,400 payment, actually goes towards your loan balance, towards the principal, right? It goes to interest, because mortgages are front-loaded. In year one, you're paying more than double in interest compared to the principal. I know it feels backwards, but it was how it's designed with an amortization schedule. It's designed by the banks and the lenders to make sure that they get paid first. Today's strategy is going to help eliminate $70,000 off of that potential interest you could pay. Okay? So here's the part that changes everything. Because interest is calculated based on your remaining balance, every dollar you pay early shrinks that balance and instantly reduces the amount of interest you pay for the rest of the loan. Okay? Watch this. If you do nothing and you just make the minimum payment, you'll pay a total of $463,000 in interest. Let me be clear. So you have a $400,000 mortgage and you're going to have to pay that. And on top of that, over the course of a 30-year loan, you will also pay $463,000. That is almost, well, it is more than double your loan amount. That's crazy, right? That's more than the house, again, that you're just paying in interest. What happens if we add just $50 extra a month? $50, one dinner out, stay in one night and have some ramen. Actually, don't have ramen. I haven't heard good things about that. Maybe just like cook for yourself. So that one extra small payment cuts 2 years and 4 months off of your mortgage and saves you $30,000 in interest. So if your mortgage payment is $1,750, just round up. When you go online and you go to pay your mortgage, there is a button that will allow you to put an additional amount towards principal. And just $50 can save you $30,000 over the life of the loan. Let's say you have a little bit of extra money and you want to bump that up to $200 a month. You will save nearly $89,000 and you're debt-free from your mortgage 7 years early. 7 years without a mortgage payment. Think about that. 30 years down to 23 years. That is huge for just $200 a month. Here's what gets even better. So for you buyers out there who came in and maybe you used a first-time home buyer program, which I talked about in another video, make sure you check out that video as well. You put, maybe some people will let you put as low as 0.5% down. You put 0.5% down on your home. That means you don't have much equity in the home. you've only put 0.5% down. When you do that and you put less than 20% down, you are paying an additional fee from the lender called private mortgage insurance. It's mortgage insurance to help protect the lender if you were to default. The lower you put down, the more riskier for the lender, right? But here's what's cool. Once you hit an 80% loan to value, meaning you've got at least 20% equity in the home, by law, the lender must remove PMI automatically. Typically, if you go in and read the guidelines, sometimes they'll make you get to 78%. So just pay attention to that. When you go and when you do a loan for the first time and you do 20% down, you can eliminate private mortgage insurance. Most people can't do that. If you do less down and then wait over time, they're going to wait for you to get to that 22% equity position and 78% loan to value. If you can verify that with either appraisal or a broker's price opinion, they are legally required to remove that payment. That can be anywhere from $100 to $200 a month. Now, what if you were going to take those extra payments of private mortgage insurance and you put that back to your equity line because they directly hit your principal? Meaning not only are you saving tens of thousands of dollars in interest and getting out of debt early, you're also potentially eliminating a PMI payment. So by taking an additional payment every month towards your principal balance, you can get to that 78% equity position much faster, which could eliminate anywhere from $100 to $200 on your monthly payment, saving you thousands of dollars over time. But let's say you just want to take that money that you're saving and put it towards the equity. So you keep your monthly mortgage payment the same. Instead of paying that private mortgage insurance, you're actually going to go ahead and put that money towards your equity. You are going to continue to save tens of thousands of dollars on your interest payment, and you're also going to get out of that loan earlier, which is absolutely incredible. So that in and of itself is a complete total another win there. So putting extra towards principal not only helps you cut interest in the tens of thousands, but it's also going to help you get to that 78% equity position much faster. So here's the ultimate takeaway. If you can add anything to your principal payment, even if it's $20, you're punching a hole in the interest schedule and speeding up the equity growth of your home. And if you ever want to run exact numbers or want a strategy to eliminate PMI faster, reach out anytime. I've done this on 2 of my properties now. If you're able to go in and purchase something that is in a great neighborhood that looks like there is growth potential, I always recommend you put the minimum down that you're required to. You leverage as much as possible so that you can keep your money in your pocket continuing to work for you. This stuff isn't guesswork. The math always tells the truth. And if you found this valuable, please do me a favor, send it to a friend or family member so you can save them $90,000 just by watching this one video. And if you want to understand how to avoid the biggest mistake buyers make before getting a mortgage, watch the video right after this. You're going to thank me later. Thanks for joining me today, y'all. Let me know what you think about this. Like, subscribe, and leave some comments.